what does trading in a bear market look like? Same scans, more short positions. Yeah, Bo, trading in a bear market, same setups, flip them upside down, brother. Flip them upside down. This is where, most people that are involved in markets right now have never traded through a bear market. Okay, so it's going to be a little bit of a wake-up call for a lot of people when we do go into our next bear market. Have no fear, my TTD fam, though, because 2008 was the last great bear market that we've experienced, and that's actually when I received the Trader of the Year award from the fund. What you are going to want to look for in bear markets, I know this may sound so silly, but I'll explain why. It's literally the exact opposite of what you look for in bull markets. In bull markets, pullbacks are buyable. Literally, you look to buy pullbacks in strong stocks. In bear markets, it's just the opposite. You short bounces in weak stocks. That is literally, it's the same type of setups. You're using the same indicators. You're just flipping things upside down. Anyone that uses Thinkorswim, I do not use Thinkorswim, I use Lightspeed, but anyone that uses Thinkorswim, they have a really, really cool feature on their charting platform where if you put the minus sign in front of a ticker symbol, it'll actually give you the inverse chart. So if you were looking at, let's say, a stock that you wanted to short, if you put the ticker symbol in with the minus sign, it'll actually flip the chart upside down and the stock will actually be moving higher instead of moving lower. It's a really, really cool feature that you guys can use on Thinkorswim for anyone that uses Thinkorswim. Little fun fact for anyone that maybe did not know that, I think it's a great feature actually on a charting software. Something that's really cool that they do. It's one of the only things that I would probably say that I like about TD. I do not like their platform, just my own personal. I just think it's too noisy. I think it's too noisy, but it's an awesome little feature. And that's what we're going to look to do. We're going to look to short stocks in bear markets. We're going to look to really go after, and we're going to really lean on put options. You guys can also sell covered calls a lot in bear markets on positions you own in your long-term portfolio to offset some of that pullback. There's so many different things you can do in a bear market to take advantage of that time period because bear markets don't last forever. Bear markets are very short time periods. The longest you might get a bear market could be like 3 years, 2 years or 3 years. Bull markets can go on for a decade. You look at the bull market that we're in now, it's been from 2009 now all the way to 2021. We've been in the bull market. Okay, so it's like ever since that crash from the Great Recession, we've been in the bull market. When that bear market comes, we're going to look to buy put options in large cap stocks and in the overall indexes. When we get bounces and when you get rallies, you're going to look to buy put options on those particular setups. We're still going to trade small caps. The small caps will not be as affected by a bear market as the overall markets will. The small caps will still be left to kind of do their own thing, where if there's an individual catalyst, a company's got news, there's a low float, you'll still get action in small caps. So we're still going to be trading small caps pretty similar to the way that we trade them now. It's the large caps that we're going to be trading a little bit differently. And then selling covered calls is something that you guys learned about in Options Palooza. Options Palooza was just this past Saturday. It was an all-day long options trading workshop. It was from 9 a.m. till 5 p.m. Eastern. Our two top pro option traders, Chris and Momin, they hosted and ran that entire workshop, and they taught you guys about selling covered calls. Selling covered calls is an excellent way to offset losses and to build more cash to average down on long-term portfolio positions in bear markets. So essentially, if you own shares of, let's say, AMD, Apple, Facebook, Microsoft, whatever, you own shares of these companies and we're in a bear market, if you sell covered calls, you are basically taking in free money and saying to yourself, let's say AMD is at $100 a share, right? And let's say you own shares and it's a bear market and AMD's dropping to like $90 or $80, you can sit there and you can sell, let's say, $100 strike call option, and you can sell that call option, realize that income. And if the stock does not reach $100 by the expiration, the option expires and you keep all of that capital. So you've just taken in free money to own AMD, and you can take that money, and then if AMD drops to $80 or $90 during the bear market, maybe goes down even lower, you can take that cash and then buy the stock with it. Once you buy the stock with it, you now have more shares in your position, so you can then therefore sell more options against that position. So now instead of you selling, let's say, one contract, now you can sell two contracts because you can only sell one contract for every 100 shares you own. So if you own 100 shares, if you own 120 shares, 130 shares, you can sell one option contract as a covered call, realize that income. Take that income, buy more shares. Now you have, let's say, 205 shares. Now you can sell two contracts. Take that cash, buy more shares. And you essentially start to just build. And all of a sudden you find out you've doubled your position size in AMD for free during a bear market when the stock price has gone down. This is an amazing way for you guys to build your positions in long-term portfolios, essentially risk-free, because the worst that can happen to you when you're selling these covered calls is, let's say the stock goes to $100. You're going to have to sell your shares at $100 to whoever bought the option from you. But if it's a bear market, the chances of AMD going back below 100 are very high because markets are drifting lower over an extended period of time. So then you can just wait for the stock to go back under 100, and then you can just buy the shares right back, start selling the covered calls again. This is a genius strategy for you to take advantage of a bear market that a lot of amateur people do not know about. This is something that is implemented heavily in the institutional and professional world. And I will walk you guys through that entire process once we get into a bear market. I promise you. We went over that. Moment and Chris went over that during Options Palooza. I will walk you guys through that entire process. And that's a good way to protect your long-term portfolios during a bear market, but also build those long-term portfolios and expand your positions. You'll go into a bear market with 100 shares of a stock. You'll come out of a bear market with 300 or 400 shares of a stock. And then when you go into your next bull market, now all of a sudden your position is 2 times, 3 times bigger than it was, and you bought it at significantly cheaper prices, and now you can ride the wave. That's what I'll teach you guys how to do during that bear market when that time comes. We're not there yet. But when we do get there, we're going to make money on the way down because that's what we do in True Trading Group. That's what a professional education will allow you to do. A professional education is going to get you to make money no matter what's going on in the markets. Markets could be up, down, left, right, sideways, inside out. I don't care. We will be making money during that market environment regardless of what's going on. You just have to understand how to profit from the opportunities that are there. It's the same execution. You just have to know where to look to find the opportunities. Like I said, the last real bear market we had was 2008. That is the same year I received one of the Trader of the Year awards from the fund that I worked at. I will walk you guys through that entire process.